Hello, this is DrPaulCottrell, and we're going to be doing a quick market update here. So there's some really important economic data that came in. I'm recording this on December 8th.
And that's a big theme for me. And that's where I actually have been buying in the markets as of late.
Hey, Joe, really quick, Joe, real quick. Joe, we have two auctions on Monday. We got to make sure everybody understands this. 87 billion, 50 billion threes, 37 billion tens on Monday. Tuesday, 30 billion with respect to 21 billion 30 years. And this is all because, of course, we have a Fed meeting on Tuesday and Wednesday. They push out the paper before the ultimate decision. And tonight, right around midnight, we're going to see China release their CPI and PPI. So just please pay attention.
Okay.
Yes, it is.
Okay. I saw it out with Megan Keller with Chris Christie. It really scared me because he didn't get enough questions. So I want to let you finish things off here because I don't want anyone getting mad.
So I would, I don't think I have a very different view. I would add a couple of things about what to watch out for. I think that expectations, consumer expectations of inflation are still high. I think we still have to look out for housing costs. So I think there are a few things that we need to watch out for. Overall, I think we are on a good path, as I said earlier. I think that there's a good chance that we will achieve the soft landing that that the Fed is hoping for. But the last 1%, going from where we are now, about 3.5% to 2%, that last 1% is going to be the hardest to achieve. So I think we still need to out.
Okay. All right.
But we're still seeing very strong labor market prints here, very strong wages, strong unemployment rates that are not really consistent with restrictiveness. And that's good from the growth side, but it may not be good to get that last mile of that 3%, 3.5% inflation down to the 2% target.
Jeff, thank you. Jeffrey Rosenberg, most often with us here on Jobs Day with BlackRock and his good work.
All right, just to get everybody up to speed here that's watching, I'm also doing a simulcast with Spaces on X. So unemployment rate was estimated to be at 3.9%, which is still relatively low. It came in even lower, 3.7. Now, natural unemployment, if you use standard economic textbooks, a healthy economy is around 5% unemployment. You go below, 5 or 4.5% unemployment, you have a hot market. Now, there are other variables involved, but when you look at decades of economic data, that seems to be the consensus. All right. The problem comes in is that are we in some sort of new type of economy? Now, it's running really hot for a long time at such a low unemployment rate. 3.7 is, from historical standards, too hot. Now, we do have inflation. So this may be an indicator that the Federal Reserve will raise rates. Now, I can, also create a case where the Federal Reserve might maintain a pause. They're not going to lower rates, that's for sure. But they may continue to pause because of the problems in the Middle East. Oil is going down in the last couple trading sessions. Oil is trading up right now. So there is probably data to show right now that the Federal Reserve is heavily thinking on raising rates again. Let me go back into Bloomberg Live.
Analysis. Gina Martin Adams is scheduled to be with us here on the equity market. A little more on bonds right now. And Lisa, we do this. Why don't you bring in Ira? And we have the 2-year yield. We had an 11, 12 basis point move. We come halfway back, maybe a third of the way back. A little bit more quiescent move.
Yeah, what I find interesting is that the initial headline number would suggest that you might as well really start to pare back your bets on a March rate cut, and yet they weren't pared back all that much. Went from a 55% chance to now 47.5% chance. Again, a real significant chance still priced into the market that we're going to get rate cuts by the Federal Reserve in the first quarter of next year. Ira Jersey has been parsing through these numbers as well. Chief U.S. interest rate strategist at Bloomberg Intelligence. Ira, what's your take on the fact that yes, markets moved? They're retracing some of that, even though there's really nothing in this report to suggest that the Fed should start cutting rates in the near future.
Yeah, I think that the market is in kind of risk management mode because the market does think that we're maybe now seeing a pretty significant slowdown, and certainly this is a speed bump in that kind of narrative that the economy is slowing very quickly. But like Mike McKee said, I think part of the issue here for the market is the dispersion and the
199,000 jobs added. The estimate was 185,000. So even the number of jobs being added are, it's just something. I think the Federal Reserve is going to be concerned about inflation, especially if oil starts to tick back up. But there's some talk that oil is going to actually start going down, not up, because increasing supply. So it's a conundrum for the Federal Reserve on what they're going to do next.
Of the job gains and the job losses, Anna Wong and Bloomberg Economics talk about the SAG strike and the UAW strike having some effect on this. So we'll need to see a couple more prints, and obviously inflation is still the key to all of this. So next week's CPI number will probably drive some of the narrative that we have from the Fed next week. That's where you can start to see maybe some changes in market pricing for cotton.
Ira, you're a claim over the years, and frankly, your team here at Bloomberg Intelligence is not only on the economics of this, the jobs report, the wither, the yields, and all that, but the confidence in the fixed income markets. I've seen a lot of gloom articles in the last couple weeks, and I've seen a lot of pros push back. What is it? Should we worry about liquidity? Should we worry about trust in the short-term paper system?
Well, I don't think we should necessarily be worried about the trust in the government's ability to pay and willingness to pay at this point, right? We'll have a debt ceiling crisis at some point right in the future, just because of the partisanship that's going on in Washington. But in terms of the size of the market versus the pipes that the market runs through, I think there is some concern there. And the government and some of the regulators are trying to nip at that at the margin, but I'm not sure that they want to take the steps that will actually help increase liquidity in a very substantial way. So I wouldn't worry about T-bills. T-bills are still very liquid. You still have a lot of cash in money market mutual funds. But when it comes to things like 5-year, 10-year, 30-year bonds, again, every once in a while you're going to see these massive moves on not a lot of liquidity. Today, this morning,
jump over to CNBC because they're talking about oil.
You're not in the room. Do you feel like how often have you been surprised at what's happening?
I missed the segment.
Sorry, I'll go back to Bloomberg.
Offers for some pretty decent size, but there's a lot of days when we get numbers like this and just all of the bids or all of the offers just completely disappear. And when that happens, you wind up seeing these outsized moves for on data that you wouldn't necessarily expect to move the market that much.
Which is the reason why a lot of people are trying to identify where consensus is and where the overshoot could be on any given day. He started out by saying that this jobs report acts as a speed bump with respect to the slowdown narrative. Does that mean that right now the slowdown narrative continues to be the consensus? People are going to price that in, and should we get another report like this, it could cause a pretty big disruption in the opposite direction with yields going higher.
I completely agree with that assessment. I think that if we see that in December, the jobs report is reasonably decent, we could easily price out, March and May interest rate cut probabilities, and I think that can happen very quickly. I mean, we've gone the other way very fast as well, right? We, think about it. Just a couple of months ago, when 10-year yields were at 5%, 2-year yields were at 5.25, we were not pricing for any cuts in all of 2024. So, we could easily go back the other way. I've been of the opinion that the bar for the Federal Reserve to cut rates is much higher than the market's thinking. So I think that we eventually will price out those early cuts.
Thank you, Ira Jersey. Thank you so much. Really, really appreciate it. This job as well with Bloomberg Intelligence. On the other side of the aisle, Gina Martin Adams is Chief Equity Strategist at Bloomberg Intelligence. Gina, we're looking at the jobs, yield, the Fed. What our listeners and viewers want to know is, I'm so far behind in this market. What do I do given this jobs report? And folks, here's the numbers. Amy, give me this if you would on TV. I'll quote it out to radio. Year to date, Standard & Poor's 500 up 13%, the Dow up 5%, and the Gina Martin Adams NASDAQ 100 up 34%. How do you take this jobs report, better than good, folded into maybe a better than good GDP, which is clearly into a better than good stock market?
Yeah, I think it's a great question, Tom, and it's certainly one that everyone in the equity universe is contemplating at this time of year. I would point first to that difference between the Dow's return and the NASDAQ return. You see a similar difference between the S&P 500 return and the small caps return. Portions of this equity market are still in an extraordinary bear market, really reflecting the recession psychology that we continue to contend with. As everything.
Let me be very clear, and I've been saying this for the whole year, and I've been playing this chart that has the different fib sequences going all the way back to 2016. There's 3 fib sequences that roughly overlap. And that's the 2016 fib sequence, where there was a correction in 2016, the 2020 correction, and then this recent bull market that started around October or so of last year, right? Now, these overlaps have shown very strong support levels that we just bounced off of, which was at about on October 30th, we bounced off of a major support level, which was around 410 for the SPY, which is the S&P 500 ETF non-leveraged. And it's been a march up continuously. It has been testing the high that was in August, on August 1st, right now. Once it surpasses that, it's going to start marching back up to 480, which is the high of the all-time high of the S&P 500. So I'm telling you, the market is going to rally by the end of the year, unless some crazy thing happens where there is a 3-front war. There's Taiwan gets invaded, nuclear detonation with tactical nukes in Europe, something that kind of like that level. But barring from that, if things geopolitically maintain, I suspect that this thing is going to test the 480 mark. It's going to surpass the 460 pretty soon here, because it's, yesterday it was at 483. Now, if I look at the futures market, it is trading slightly down, but that doesn't mean it'll be like that the whole day. But we have, we're just in the first week or so. Well, we're in the second week of, it's 12/8. So we're basically, starting the second week of, Monday will be basically the second week of December, roughly. But so we have quite a few trading days left in December. It's gonna test. It's gonna try to get to the 480 mark. This is gonna be a rallying market, and of course the hedge funds and the investment houses wants to close out a year that is as positive as possible, because next year is unknown.
But the jobs market indicators has been pretty sour over the course of the last 2 years. The equity market has been stuck in this sort of recessionary malaise, with a few exceptions, all being tech-related, tech-adjacent stocks have performed incredibly well over the course of the last year. So this is clearly not about the economy in the equity market. The economy is keeping most of returns somewhat suppressed. They're keeping small cap returns, international returns very low. But what's working in the equity market are companies that are experiencing
Right.
earnings recovery, earnings growth that has nothing to do with the underlying economic numbers. So that sets you up with a really good strategy for 2024.
Well, my
If
really
the economic outlook changes, you've got to change your investment strategy.
Gina Arnaz, my strategy is to get to Lisa Bramowitz because she's got some really good questions here on the equity markets. But I want to note that equities are beginning to lift down. Futures only -4.
Yeah.
Dow futures only -35. We've got a comeback in the market here. And if we get a
It's going to
comeback,
play like this. We're going to try to test the 480 mark this year. It may not make it, but it's going to get close. It'll do a double top. It'll test the market, and it's going to bounce down. It's going to do a minor correction when it hits close to that 480 mark, and then it's going to retest. And if there's enough energy in the market in January to retest to get past the 480 mark, it's going to be a major rally in at least the first quarter of next year.
next year, off of month after month, are surprising this resilient job economy.
Yeah.
Do we underestimate where those blended and tech estimates are going to be in June?
Yeah, we very well could. As a matter of fact, I think there's a very strong chance that the market is mispriced for 2024. And most people would say that the market is mispriced because analyst expectations are too high. Our work would actually say the market is not priced in line with the analyst community at all. The market is anticipating close to 0% earnings growth over the course of 2024. If anything near the analyst estimate of about 11% growth comes true, that will be another second consecutive year of upside surprise on the earnings story. While we've all been completely and totally captivated by what all of this data means for the Fed, the other half of what really drives stocks is what's going on with earnings, and we very well could be set up for another earnings surprise next year.
Which is the reason why, Gina, part of what's interesting here is that people are underestimating how much capacities companies have to keep hiring, right? The flip side to this story, which is that they see more downside to not being sufficiently staffed than upside from possibly cutting costs. This from Jason Furman of Harvard, just out. We're now at 2 million jobs and 2 million employed above CBO's pre-pandemic projections, that we are actually at a better spot than before the pandemic we were extrapolating out. Gina, where do you see the biggest gain to be had from the figures that we're seeing right now with respect to hiring, with respect to where people are really hoping to beef up?
Yeah, so I actually think the biggest potential gains in terms of hiring are going to come from the areas that already cut. If you think about the longer term scheme of what's happened in the job market, we had tremendous job cuts throughout the pandemic experience. The sectors that did not cut jobs, cut those jobs in the end of 2022 and early 2023.
The S&P 500 futures is down by eight points right now. Now, the reason for that is the traders would say that this better than expected non-farm payroll and the unemployment rate going down is going to pressure the Federal Reserve to raise rates. So it'll be a cooling of the market. That's what they're pricing in, at least short term. But there's enough momentum for the rest of this year. I suspect that this is going to test the 480 mark on SPY.
Are sectors like technology, communication, to a lesser extent, financials. So if those are also the groups that are experiencing the most robust earnings recovery, in particular, the tech sector is starting to really produce strong growth, communication stocks producing very strong earnings growth. Those are the segments of the market that are leading what's going on in the broader market. Those are the segments where they're already cut to the bone. If they continue to produce positive cash flow growth, positive earnings growth, we're going to see hiring come back in that space first.
Which, if you flip this on its head, you said earlier that maybe people are focused too much on the Federal Reserve and should be focused more on earnings. At what point do Fed rate cuts or not matter for equity valuations?
Oh, I think they definitely matter.
Of course,
if you look at something like the small cap sector, for instance, the small cap index is trading at multi-year discounts relative to large caps. It's very clearly suppressed in terms of valuations. When you look at the S&P 500, you exclude the tech sector alone, and you've got a multiple that's closer to long-term average. So there definitely is some pent-up demand that could be sitting on the sidelines for equities. Just based on valuations alone, a cut in the Fed funds rate could go a long way to catalyzing some degree of valuation expansion in all the groups and sectors that have frankly been left behind in this very tech-specific recovery that has emerged in 2023.
Gina,
Let's
just
go to
absolutely
Kramer. I
great.
want to hear what he has to say.
I'm losing because I bet you they would have gone short, you saw what happened to the futures right after. And now they've come more or less almost all the way back.
David, with a series of great calls.
So I did save somebody, I think.
Well, I
Well, a
just
friend
think-
of mine, and I know, I do know that they tend to do that.
Well, okay, so you're.
I was like, don't do it. Don't get off the phone.
Well, I think that the bias toward action by them is very unrealistic for what, if I'm Jay Powell. Jay Powell says, look, I can keep rates up. We got a 3.7% unemployment rate. Why, shouldn't I wait till it gets like 4.5 really to start cutting? Because right now we're just beating inflation over the head. Let's keep beating it.
Yeah, there are people starting to slice and dice, take away the UAW effect, take away SAG-AFTRA, take away government,
Right.
and take away healthcare. And some of these non-cyclical areas, Jim, you're looking at 26K for the month.
Manufacturing is a little bit stronger. We're spending $1 trillion to reshore it. We could create 20,000 jobs. A lot of people are confused by that healthcare number because we just don't see it in the system. You look company to company, but this is a very strong report, and I think that those who keep looking for revision that's down, you get a revision that goes the wrong way. But I think good is good is what I'm saying. I think that when you read some of these strategy notes you're starting to get, their biggest fear is a recession. They should wake up and start with coffee. They really should.
Meanwhile, we got gasoline futures 2-year low. Oil's on pace for 7 weeks down. Haven't done that in several years. Meaning, does the tone of the meeting change next week?
I think that the meeting can be, look, we're going to watch and wait. If we see weakness, we'll take action. But
We get CPI and PPI.
yes, right before,
Yeah.
right before.
So
I think
that's
they're
going
going
to
to
be more
That's my point on
important
oil.
than
I mean, the headline's going to be.
Look, it is important, but don't they have a statement? Do you think they changed the statement maybe on CPI? I don't know. Look, we've been dealing with companies all week, like take Toll Brothers. I mean, the homes are $1 million. That's not what the Federal Reserve wants.
Yeah, but there aren't that many.
Right, but I'm
So,
saying
I
that
mean,
the price of the house is up 40%. There was a really great moment in the Dollar General call. By the way, extraordinary call. They have the old CEOs back fast business. It cost them 30% more to make a store than it did 3 years ago. Well, that just makes the prices go up at this stuff. Well, or they take out an Oreo. We do that. When you buy a package, you say, wait a second. I think there's some Mike and Ike's missing.
Well, now you're getting to David's Malamar's.
Mara, you've been listening.
Yes.
For years.
He knows if there's one fewer Malamar.
They cut back 10 on the side to 9. That was years ago. And then they made it smaller. But I think Mondelez has stopped the shrinkage for a
You
little while.
do? I think Mondelez.
They took the tapes that were like this, and the tapes are now like this.
I think I'm worried about shrinkage there. Not stealing. But the Toblerone, I bought it in Italy. I think it was like, I don't think it was
I think
I think it was
the main point that Kramer's making, and he's trying to be funny about it, is that there is an inflationary pressure in creating stores, and the cost to do that. There's the trying to meet market expectations by the analysts for profitability, and then shrinking the amount of a particular product, especially in the food stuff industry. So I mean, what he's saying is, making sense. Let's jump back into Bloomberg here.
Significant job growth, higher wage growth, and high labor force participation. And I don't think the fixed income market would have sold off this much had it not rallied excessively in the last few weeks. So bottom line, John, this is good news for the economy, and the market has to think very carefully about the amounts of cuts it is pricing in for next year.
Rodrigo, where did this come from?
So I'd say a couple of things I would talk about on the show all the time. You have a different economy than you've had in the past. We had 99,000 jobs in healthcare and education out of 199,000 jobs. So you got to parse the data. And you don't have the standard cyclical economy. You have a service-oriented economy where we're still hiring a lot of nurses and teachers, and it manifested itself again today. That is the one going forward that I think is going to be worth focusing on. Part of why I don't really believe
in this soft landing, hard landing. I just think in a service economy, you're just driving to a slower economy, but nothing that bad. One other point that I would say, and touching on what Mohammed said, you have a lot of people that are joining the workforce as well. Another 500,000 people come into the labor force. So I think there's something that's important here. You are building the dynamic around more people coming into the labor force. You saw the JOLTS report, some hiring coming down. So you're building slack, but really, really slowly. And again, it's an environment where the Fed can sit back, wait, and then I think the latter part of the year they can start cutting rates. But as Mohammed said, markets were a little overzealous. They were pricing in a March, more than a 65% chance of a March cut. That seems overdone, to say the least.
Mohammed, let's build on that. The difference right now between where the market is and where the Fed is and what they're
The
trying to
Federal
communicate.
Reserve would hold rates for at least 2 quarters before they would start to reduce. And the chances of them going up the probability is getting higher. So, this is definitely a tail end, probably Q4 of 2024 if there's a rate cut. I don't think that's going to happen. I mean, sooner than that. This market is economically, it is strange. I mean, it's been hot for a long time. And, the economic theories are starting to break down in terms of what natural unemployment really is. It's strange. It's strange. I don't have an answer for it, but I do see that the trajectory, and that is that at least in the short term, it looks like the broader market, the S&P500 and these larger indexes like Russell index, they're going to be moving upward. Don't look at the Dow. Dow is too small in terms of number of companies. You want something that's more broader based. Dow is just 30 companies. The S&P 500 is 500 companies, so you get a broader idea of what's going on in the market.
Yeah, it's striking. We've seen this already last year when the market expected rate cuts this year, didn't get them, and the market rushed again and priced in early and significant rate cuts. Look, the Fed is not happy with the loosening of financial condition that has happened in November and early December. And it's been a massive loosening of financial conditions. And what this report confirms is not only that we have a solid labor market, but also, as Rick rightly said, keep an eye on the service sector, because in order to get to 2% inflation, you need goods deflation to continue, and you need service disinflation to accelerate. And I don't think we're going to see the service disinflation accelerating with what's happening in that sector. The bottom line, John, is back to the Fed is really unlikely to start cutting in March, as markets were expecting. I mean, now I think the latest now implied probability is about 47.5% for March. That's still too high.
If that's the bottom line, here's the headline: 199 in the payrolls report, an upside surprise. Unemployment down to 3.7%, and wages looking decent. Mike McKee's got the details. Morning, Mike.
Good morning, John. Well, the Labor Department seems to have had a problem with its release, but we have all the numbers right now, and it is 199,000, as you say. Interesting thing, revisions, negative 35,000, and that is all to September. October was unchanged at 150,000. Manufacturing jobs up by 28,000. We'd lost 35,000. That's a return of the United Auto Workers. So subtract that out, you get 171,000, which is still strong job growth for the month. The unemployment number is the stunner for the month, 3.7%, as more than 700,000 people entered the labor force, more than 500,000 of them new entrants, not moving over from unemployment to employment, but coming into the labor force. And that's going to be greeted with huzzas down at the White House. Average hourly earnings, 0.4, up 4% on the year. And on a 3-month annual basis, up at 3.4%. It had been 3.7 in October. So we're seeing.
Let's think about this.
Healthcare,
out of that increase, healthcare was the largest. And then government jobs. Now, healthcare was 76,000, almost 77,000, and government was almost 50,000. So more than half of the increase was, relative to the very top increase, more than half of that was government jobs. 150 out of 100, almost about out of 150,000, roughly 150, no, 125,000, 50,000 of it was government jobs. So, if you look at the data, I mean, it's like, well, maybe we're hiring too many people in government. Retail went down by 38,000. Hospitality went up 40,000. It's there's a story there. Probably we're spending too much with the government jobs, that's for sure. You would probably have a flat unemployment rate from one period to another if it wasn't for the government hiring.
Time when we're still seeing a lot of jobs out there. Where are the jobs? Healthcare, as always, 77,000 basically, and government 49,000. Interesting thing here for those on the campaign trail, these were all state and local jobs. It wasn't an expansion of the federal government. Leisure and hospitality up 40,000. Most of those restaurants, maybe some department store Santas, except that retail hiring was down by 38,000, and almost all that comes out of department stores. So not clear what's going on there. Coming into this, there had been talk that the SOM rule would be triggered, that when unemployment rises by a certain amount off its lows, that you're in recession. We're not in recession, I think, is the easy way to sum that up right now, John.
Just had 5% plus GDP growth in the third quarter, Mike. And we've just got unemployment down to 3.7%. Mike McKee, thank you. Plenty of takes rolling gear. Here's one from Neil Dutta of Renaissance Macro. The labour market is not the primary driver for monetary policy right now. He goes on to say, indeed, there is an asymmetry in the Fed's policy reaction function. Stronger employment will not push them away from a cut as much as weaker inflation will push them towards one. Rick, I'd love your thoughts on that quote right there. Is this labour market no longer a reason to be hawkish?
So I actually think it's right. So there's a couple of things at play here. Does the Fed have to cut quickly because of a real slowdown in employment? Clearly not. We've ruled that out. But there is something, and Mohammed said it. So let's break down inflation. If you take service level inflation is running at 3.5. That's down from 8. So the momentum is good. Goods inflation is actually deflating moderately, but it's service level inflation you have to bring down. My sense is that will come down, but it'll come down very slowly. So what does the Fed do? So now take the funds rate. You've got a funds rate at, let's say, 5 3/8. If you've got inflation, if you've got core PCE, core CPI next year, that's going to get down to 2.5. And we think that's about where we're going. That's a Fed projection. That's about our projection. So you've got a funds rate at 5 3/8. You've got inflation running at 2.5. You've got real rates that are way too high. So you've got to cut rates, I think, 100 basis points to get to what is, quite frankly, a somewhat restrictive level. And I think that's what's going to happen. But it has to be instigated by that service level inflation. As Mohammed said, you're just not going to get core goods that deflate that much. You've got to see some moderation in service level inflation. My sense is you'll get that. But it's slow. By the way, things like shelter come with a lag, so you think that would slow. But there's some sticky things. Medical supply, healthcare insurance, auto insurance, some of those things are just sticky and they're not cyclical, and it's hard for the Fed to influence them.
Well, let's get to the Federal Reserve. Mohammed, next week, 3-part act, statement, news conference, projections. What are you expecting next week?
So I think they're going to repeat, because they're going to try and push back against the loosening of financial conditions. So they're going to repeat what we heard from Chair Powell on Friday, which had 2 parts. It's premature to talk about rate cuts, and we may still need another hike. I don't think they'll believe the second bit, but they'll need to see it. I think in terms of what they project for next year, I am where Rick is, probably more like 100 basis points of cut than the 250 that the market has. And although they will not tell us that, it's more likely to come in the second half of the year than in the first half of the year. So that is what I'm looking for and expecting from this Fed. It'd be interesting to see how the market reacts. The market, as you know, has had very selective hearing. And it was stunning to me that last Friday, when Chair Powell tried to push back against what had been the massive loosening of financial conditions, he basically got sidearmed, or I think you called it steamrolled, is the phrase you used that day, by yields coming down 10 basis points, despite what he said. So it's going to be interesting to see how closely the market listens to the Fed. But the market right now is totally ignoring Fed forward policy guidance.
I'm pleased you brought that up, Mohammed. Rick, let's talk about it. Mohammed's right. Chairman Powell got absolutely steamrolled. If that was pushback, this bond market looked right through it and laughed. Is Wednesday going to be any different?
So maybe. So with a couple of, by the way, we also get a CPI report that's probably not going to be that soft. So listen, so I don't think Chairman Powell will be very different. But so let's break down the parts of the yield curve, because I think it's worth describing this. The very front end of the yield curve. We've been on the show many times talking about buy the front end, buy the front end, buy the front end. This month, it was time to sell the front end. There is the front end got crazy overdone. There's something that's really important though, and it's something that I'm really be focused on. If you take the long-term Fed funds rate and you assume that it's going to be 2.5, maybe a little bit higher than that, the one thing that I think you can start doing now is I think you can start buying to the belly of the yield. We talked about it this month, and I think in your show and others, you can start buying out to the belly of the yield curve, because the forwards are now priced again a level that is not there where the long-term funds rate is. So I think, quite frankly, you can be more comfortable today. Forget the front end, other than some cash management, obviously. But I think the belly of the curve, if you get some nice, hopefully get a back up here. And I think the forwards are interesting, and I think you can now hold some interest rate exposure, because I think we're done on hikes, and now we can start thinking about longer term cuts, and that's where you can get paid for it out more a bit further out the yield curve.
When you speak to people, are you seeing appetite to do just that, Rick? When you say the belly, we're talking about what, 5, 7s coming out of front end? Is that happening?
Definitely. So 3 to 7 year part of the curve, and 100%. And you've seen some of the flows. By the way, you saw some flows, significant flows on the back end of the curve. That's pension, et cetera, that was driving the back end to pretty aggressive levels. But that is, I would argue, largely non-economic, defeasing or locking in your funding against your liabilities. But yeah, there is definitely some. I think as you get into 2024, people are going to get more comfortable with inflation, the persistence of a stable to lower inflation. And more of that, people are going to say, I want to lock these yields in because we're at pretty good yields. If we're getting to, so let's say the economy GDP runs at 1.5-ish, or maybe a little lower next year, and you get 2.5 inflation, these yield levels for, you can buy quality assets, quality yield, 6%, 6.5. People are going to have started and are going to start locking that in.
Mohammed, final word. Do you agree?
I do. I think the harder call, and you should give the final word to Rick, the harder call is what do you do with US credit, where spreads have really compressed. And a lot of people are hoping that they will get both the yields and the spread benefits to their bottom line. And both things have come down significantly. So I think the harder call right now is what do you do with US high yield, for example, Rick?
That's too hard a question. So I said a couple of things. I think Mohammed's right. I think spreads, particularly in high yield, when the economy's slowing, it's just okay. Investment grade credit, though, and I completely agree, the spreads aren't that sexy, but because you think about what happened when rates were at zero, all these companies termed their debt out, including European IG, which I think is pretty darn attractive because of the cross-currency basis, but they termed their debt out. So now they don't have a maturity wall, and you're buying, because the risk-free rate is so high, you're able to buy things like European credit as a dollar investor at 6% investment grade credit. So I totally agree on spreads, but for higher quality credit that you're not really worried about a default cycle, I think the yields are okay, and or not okay. I think the yields are attractive, and I think a year or two from now, people will say, "Gosh, that's a pretty good way to finance companies if you can buy good quality companies at these sort of levels."
We've got to talk about stuff.
I'm going to go to commercial. So please go to my store, the-studio-reykjavik.com. Link is in the description of this video. We're also doing a simulcast on Spaces, so I appreciate the ones that have been going in Spaces and listening. Please go to my store, the-studio-reykjavik.com, and get the D3 vitamin that I have. This is important because it helps with gene expression. If you're low on D3, you won't have the cofactors for gene expression. So D3 is a cofactor for gene expression. So that's important for cellular health. It also helps with apoptosis if the cell needs to go into apoptosis. And it also will help with calcium absorption. So please make sure that you go and get the D3 on my store, the vitamin D3. I have also ashwagandha root. This is part of the anti-aging protocol. This will help to bring down the glucose levels and reduce that inflammatory response at the vascular level. So by doing that, you are bringing down that that inflammation. You also need to take turmeric. This not only is an antioxidant, but it also brings down inflammation. Bringing down inflammation with ashwagandha and turmeric is part of the anti-aging protocol, because by bringing down that inflammation, you are not having your body in this kind of regular fight because it's overly inflamed. Resveratrol, it's a very good antioxidant. It is synergistic with C60, and what it will do is it will absorb some of the free radicals, but not just that. It has been known for many, many decades to slow down the aging process. It helps get rid of senescent cells. That's important because when your cells get to a certain point and your telomere lengths shrink, the cell either goes into apoptosis or stays senesced. And that senesced cell basically is not dividing anymore, but it's not willing to die. And it kind of builds up garbage in the cell and you want to get rid of it. So in most cases, so part of the aging process is not getting rid of the senescent cells that need to get rid to be purged from the body. Resveratrol helps with that. When you do that, then it helps stimulate, it creates signals to the basal layer that has, for tissues that have adult stem cells, it'll send signals because the system is sensing that there are cells that are being purged out, that the senescent cells are dying off and the cells are going through apoptosis, right? The basal layer will get a signal and then it'll start to tell the adult stem cells to start to divide, start to repopulate that tissue. Not all tissue has stem cells, adult stem cells, but many tissues do. And that's part of our healing. When we get older, that whole process isn't as robust. So the whole point of this anti-aging protocol is to keep that robustness. When people do not follow an anti-aging protocol or have poor lifestyle habits, what will happen is that whole basal layer gets garbaged, it gets perturbed and damaged. And you're trying to prevent that. You're trying to heal that. So pay attention to what I'm saying about the anti-aging protocol, and you will notice that you are aging slower. Probiotic is really important for proper absorption, energy absorption, nutrient absorption, but not just that. A proper gut biome is going to actually help with your metabolism and that communication between your gut and your liver. And it'll also help with the gut and the brain connection. Vitamin C is really important, not just as an antioxidant, but it helps with the dermal layer cross-linking with collagen. So take vitamin C on a regular basis. On top of it, we're going through the cold season, so make sure you stock up on the vitamin C that's from my store, the-studio-reykjavik.com, and be prepared for that. But it is an antioxidant, but it's not as strong as C60 or resveratrol. But you still need vitamin C for other reasons, such as skin health and helping with the immune system. C60, extremely strong antioxidant. It neutralizes free radicals. All right. Why do you need that? If you have a buildup of free radicals, you do damage to the cell and damage to the mitochondria that's in the cell. And when that happens, your cell isn't working properly and your mitochondria is not producing the ATP that you need. And this is the reason why people that grow older, they have a lot of free radicals. They're not neutralizing them naturally. And what happens, their ATP goes down and they just age faster and faster and faster. It's a spiral downward. You want to stop that. So take C60. It's in an avocado oil or in coconut oil. C60 is a carbon molecule. There's 60 carbon molecule. It looks like similar to a a soccer ball. It's called a buckyball. And when you do that, it'll soak up those free radicals and those reactive oxygen species and improve your cellular health. It'll reduce the cells that are going into temporary or permanent necrosis, and you're going to start seeing higher energy levels. In addition, when you take this, that higher ATP is going to help with your immune system, because you need energy to have a robust immune system. Not just that, your neurons have a lot of mitochondria to produce the ATP to be able to fire those neurons, to have those neurotransmitters being released. If you have poor mitochondrial health because of cellular stress, because of free radicals, you're not going to think as well. And this is another reason why cognitive function goes down when you get older. So pay attention to me. Take the C60 on a regular basis. I take it with a teaspoon a day, and you just swallow it. It's best to take it on an empty stomach. If you work out, it's best to take it before you work out. You'll actually recover faster after your workout. You'll notice. If you don't believe me, do a workout for 3 days without taking C60. All right. Then compare it to doing a workout by taking a teaspoon of it a day right before your workout, and see how you're recovering. And you'll notice that you'll recover faster, because it's reducing those free radicals. When you work out, you actually produce more free radicals. But especially like marathon runners and triathletes. I also take structural nanosilver liquids. I have 3 types. I have the silver solution, that's the one that I have in my hand, is 30 ppms. I also have max 35, which is 35 ppms, and then max 14, which is 14 ppms. You take a teaspoon of it a day. If you're not feeling well, take a tablespoon of it a day, or 2 tablespoons a day. What you do is you basically swish it in your mouth for about 20 seconds, 30 seconds, gargle with it 20 seconds or so, and then swallow it. It's neutralizing pathogens. And, you do that on a regular basis. And that's another pillar of my anti-aging protocol. There's 3 main pillars: neutralize pathogens with liquids and gels, structural nanosilver; neutralize free radicals by taking C60 on a regular basis; and bring down inflammation by taking turmeric and ashwagandha. Then you add stuff to it, like the probiotic and the other thing, the vitamin C that I was saying. The resveratrol is synergistic with C60, right? And D3 for the gene expression, and you're going to fare a lot better. So I also have a product that's a structural nanosilver soap. I have 5 different versions of it. This one that I'm showing on the video here is the lemongrass, but it's a high quality soap. It's made from structural nanosilver. So please go to the store and get the soaps. It's perfect for a holiday gift. I also have structural nanosilver gel. It neutralizes pathogens. We're in the cold season. Use this, put it on your hands. It stays active for 5 hours. It's a lot better than Perel. You can put this around your mouth, around your nose, and lightly coat your nostrils, around your ears and around your eyes, and lightly coat your ear canal. And what you're doing is that you are neutralizing pathogens. It also can be used as a skincare product. You can keep it on your skin overnight, exfoliate in the morning, and you'll notice that your skin is clearing up. It can help with acne, and not only that, it can help with healing a cut, minor burn, abrasions. So it usually, if you're taking it for a cut, it might heal at about a third of the time faster, about 30% faster. I also have another version of this silver gel. The one I just showed you was the 24 ppm parts per million. This one is 35 parts per million, and it has a quick dispenser. It has a little pump that you can just carry in your bag. It's very portable. So you know, try this product out. You apply it this exact same way. It neutralizes pathogens. It can be used as a skincare product. So please go to my store, the-studio-reykjavik.com. Let me go back to Bloomberg here. Oh no, Bloomberg's in a commercial. Let me go to CNBC here.
Please. What, then the bouncer at the porn night?
Did you look at Gemini? I mean, I felt like, you know, after that, I said I looked like Daniel Craig. The dubious Daniel Craig.
Strip club bouncer, that's what I was going for.
Lulu's the biggest S&P loser of the Open Gym. We didn't mention RH either, if we're talking about the high end.
Oh, that one. Okay, so Gary Friedman's been on the show a number of times as CEO. He was quite defensive and was making the point. He's talking about using our shares.
The Dow and the S&P 500 futures are still.
This is the
Oh no, the trading just started. Trading just started. So Dow is down 25 points, S&P 500 down 5 points.
Yeah, Toll's doing fine, we know that, but and the numbers, 3.2 million, something tiny.
Their sales.
Never had a lower number.
The fulcrum of their sales are new homes for rich people.
Oh, is that true?
Yeah.
And frankly, that right. Oh, all right. So they're basically furnishing all those
right.
homes. Yeah.
Right. And they the highest end, and they're talking about Munich. Say something about Munich.
It's not going well for you right now.
No, and that's why he just saying, listen, frozen housing market is the worst for you.
Although
it is frozen.
We got mortgage rates here down for the 6th straight week, 703. UK sub 6. It's actually sub 7 with a 6.
Doug Yearly saying, look, it's just going to make it so that there are even more homes that they can do one. They're actually going to build a few more than they have spoken for. They were just building ones that are spoken for. But look, it's a bad market for Gary, but
it's still the differential in terms of where your mortgage rate is now, and I'm sorry, where your mortgage that you have and where the mortgage rate you have to get is still so wide, given that rapid increase in rates.
Right, and what's the big sticking point is how many people actually did refinance, and they don't want to give up that 3.5.
Are they going to really wait to get back to that exact level?
Gary thinks that Gary's kind of negative short term. Wow, I felt for the guy because the analysts were like, no, see, 2008 was bad for house. He didn't realize he's speaking about transactions, but no one said the obvious, which is hold him. Or Albert Williamson.
That showroom they have at Meatpacking. That's amazing. Don't you think? And you can't.
All right, so that's the morning open. Dow is still down 15 points. S&P 500 down 5 points. Looks like oil is going up a little bit for the futures for WTI. So that's the update. Please go to my store, the-studio-reykjavik.com. Get the products that I offer. Pay attention to the protocol. Get ready for the cold season in the United States, and all the other stuff that's floating around, like RSV and influenza and mycoplasma and all this stuff. Please subscribe to my channels. I have 3 channels on YouTube. I am heavily censored. I just released a video that I did with Peter Duke. He was promoting his book. He just wrote a book and just recently released it. You can purchase it on Amazon. It's called Stealth Power and the Illusion of Democracy. And that video was taken down on YouTube on one of my smaller channels. I had it published on 2 channels, and I had it published on Brighteon, Bitchute, and Rumble. So YouTube took it down on my smallest channel on YouTube, and on the mid-sized channel on YouTube, I took it down so I wouldn't get the strike. So I am censored, all right, just by some of the people that I talked to. And we didn't say anything that was really, too crazy out there. So, unfortunately, I am censored. So it's important that you subscribe to all my channels so you get to see the content, and at least to see it premiere on YouTube. So please go to my videos, click the links, and subscribe to all my channels. On top of it, please ask your social media network and your friends and family to subscribe to my channels and to follow me on X and on GETTR. That way you can get updates, all right, of what I'm doing and what I'm saying. I talk about financial stuff. I talk about what's been going on in the Middle East and the physical aspect of it. And I also go into detail about the science of the crisis that's emerging and the crisis that we just went through. You know, there is this post era aftershock that people need to pay attention to and take heed to some of the things that I'm saying. So please help me by getting your social network to follow me, right? I'm heavily censored on YouTube and they bleed me. Every time I post, they bleed me. So, in terms of subscribers. So, and it's been happening for 4 years. So I would appreciate the help. Share the links, especially from Rumble. All right. Because that seems to be stable in terms of not being censored. And please go to my website, the-studio-reykjavik.com. And if you would like to help support my news coverage and you would like to donate, you can donate through Stripe or PayPal on my homepage of my website. At the very bottom, you can just click the Stripe button or the PayPal button. You can also donate through Buy Me a Coffee. And you can be a paid channel subscriber to my Patreon channel. All my content is free. I do not put anything behind a paywall. So please help support my work by donating, by buying the products, by sharing the links, by getting people to subscribe. And that way I can inform more people about the crisis that's emerging. What I have to say is really important. All right. I've been playing videos to give you kind of some meta analysis on the overall mosaic that's emerging, and how to adjust for your personal situation. So please help me help you. All right. So thank you for listening and have a nice day.